Oil prices seem to swing wildly. One day gas is expensive, the next crude is crashing. Why? It's a mix of supply, demand, technical factors, and market sentiment. OPEC Plus decisions, US shale booms, and global economic slowdowns all play a part. Technical chart patterns and a strong US dollar can also trigger sharp drops. By the end, you'll know exactly why oil prices fall and how it affects you. Let's dive in. OPEC Plus is like the world's oil supply manager. When they boost production or members cheat on quotas, millions of extra barrels flood the market. More supply with steady demand means prices drop. Even rumors of extra output can send traders into selling mode. It's a delicate balance. Any slip can tank prices. The US shale revolution changed everything. Fracking and new drilling tech made the US a top oil producer, adding huge supply. When American output surges, global prices fall as the market gets flooded. Producers worldwide are forced to compete, driving prices even lower. US drilling reports are now must-watch for oil traders. When oil prices spike, governments can release oil from strategic reserves. This temporary supply boost can quickly push prices down. Even the announcement alone can trigger a drop. It's a powerful but short-term tool to calm markets. Critics say it distorts the market, but it's effective in the moment. Oil demand is tied to economic growth. When the global economy slows, factories cut output, travel drops, and oil demand plunges. Less demand with steady supply means a surplus and falling prices. Major economies cutting back can trigger a sustained downtrend. Sellers slash prices to move excess inventory. China is the world's biggest oil importer. If China's economy slows, oil demand can drop by millions of barrels a day. Weak Chinese data sends shockwaves through the oil market. Traders obsess over every sign of a slowdown. When China sneezes, oil prices catch a cold. Even the fear of a recession can crash oil prices. Investors anticipate lower demand, so they sell oil contracts before a downturn hits. Businesses and consumers cut back, slashing oil use. This fear-driven selling often starts before any official recession. Oil prices can plummet on just the threat of economic trouble. Traders watch key price levels called support. If oil falls below support, it signals sellers are in control. This triggers automated selling and panic, turning small dips into big slides. Broken support can start a chain reaction of selling. It's a technical signal that often accelerates price drops. Chart patterns like head and shoulders or descending triangles warn of falling prices. These patterns show sellers gaining strength and buyers losing ground. When patterns break down, traders expect sharp declines. A series of lower highs and lows confirms a downtrend. These signals often become self-fulfilling as traders act on them. The death cross happens when a short-term moving average drops below a long-term one. It's a classic bearish signal. Big funds and algorithms often sell when it appears. This can add major selling pressure and confirm a new downtrend. The death cross tells the market the bears are in charge. Oil is priced in US dollars worldwide. When the dollar strengthens, oil gets more expensive for buyers using other currencies. This reduces global demand and puts downward pressure on prices. A rising US dollar index is usually bad news for oil. Currency moves can move oil prices even if supply and demand don't change. When fear hits markets, investors flee risky assets like oil. They move money into safe havens, bonds, cash, or the dollar. This risk-off shift triggers waves of selling in oil futures. Oil prices can drop sharply, even if fundamentals stay the same. Sometimes all these bearish factors hit at once. OPEC plus oversupply, US shale surges, weak China data, recession fears, technical breakdowns, and a strong dollar. This creates a perfect storm of panic selling. Traders rush for the exits, accelerating the downtrend. Oversupply fears become self-fulfilling as everyone tries to sell first. That's when oil prices crash hardest. Oil prices reflect a global tug-of-war: supply, demand, technicals, and sentiment. These forces shape what you pay at the pump and for everyday goods. Understanding them helps you make smarter decisions as a consumer or investor. Stay informed, watch the trends, and you'll be ready for the next big move. What do you think? Are oil prices heading lower? Let me know in the comments. Don't forget to like and subscribe for more market insights.